It's not just treasury bonds and other, quality quality bonds. So it affects everything down the line. Every company, every tick up means it's more expensive for every equity out there to run their business. The more it goes up, the less it's worth, because that cuts into your cash flow. It cuts into your price to earnings. Okay. It's the opposite. You don't want to see rates go through the roof. The bond market is telling everybody that it thinks the market is going in one direction. But then again, you're getting it from three different ways. You're getting Japan, you're getting the euro, and you're getting the treasury bills and bonds and what have you. So, they're running around looking for yield, these big companies, or endowments and insurance companies and pension funds. It's all about return for them, which each tick down in the price of a bond and the up with the yield, they have certain ratios that they must maintain based upon their legal documents that they created these things. It's like a trust. Trust says you can't buy, socially irresponsible companies or something like that. Same thing with the pension funds. They can only do so much. Futures, people who trade the futures, CTAs, they do the same thing. Hits a certain level, they're required to go short or long, depending on what level you're talking about. There's parameters, trading parameters that they must follow. Same thing with the S&P 500. The ratios of the companies within that 500, they must maintain certain levels. If one company spikes, well, you change the overall equation to weight it properly. That's a constant change. So any change in the price in the equity markets is going to affect the indexes. And that,
So I think,
again, goes back to the black boxes that Mark was talking about. And it affects that. It's a big cycle.
I think, when I look at it, Mike, and tell me if I'm wrong, the bond market's telling us, look, you guys are, whether it's the US or Japan, you guys are in too much debt, and we don't, our confidence in you paying us back over long term is low. That's why we're raising yields we want more money for that, correct?
Yeah, they want more return for the risk that they're taking on.
Exactly.
And I just saw an email I wanted to read. It was about Japan.
Mike,
The
this
title
is Japan's interest rate, and going back to 73. So it gives you an idea where they've been since basically 95.
Yeah.
And now it's moving higher. So these guys have been used to cheap money,
Yep.
and now it's moving higher.
Yeah.
And that's a negative.
Bonds aren't exciting, but they sure affect our life, don't they?
Yeah, they do.
Basically, it's a supply and demand issue. There's too many bonds out there and not enough demand to buy them.
Yeah.
What happens? The yield goes up until somebody says, oh, okay, now Japan is worth maybe 2% instead of 1.5% where it is now. That's what they're looking for. That's an equilibrium, and within the bond market. But that's the driver of everything. It's the bond market. Watch where the money is going. It's always about where is the money going. It's
Yeah.
not going into 10 years. Where's it going? Is it going into Japan? Is it going into, excuse me, equities in a foreign market? Look for the change in pricing. It's inverse. If it's coming out of the US is going down, and in other currencies going up. Why? Because you have to buy the currency to buy the bond. Demand.
It's interesting because when Mike talks about the US is going down, he's meaning that the bond price is going down, but our yields are going up. And that's what confuses a lot of people, is when yields go up, the price of a bond goes down, and opposite. Yeah. And so it's confusing to a lot of people in the bonds who aren't used to bond markets.
It's the same thing with like
Yeah.
options. You talk puts and calls, buys and sells, and puts and calls. I mean, they're the opposite of each other, but they don't work the same way. Same thing in the bond market. Government bond is different than a corporate bond, a high quality corporate bond from a high
Junk
yield
bond
bond. You
and
know,
the corporate junk bond too.
yeah, yeah. That's why
Right.
those rates are always a lot higher. You're taking on more risk to lend money. But that's what drives the overall economy. It's debt.
It
Plain and
does. Well,
simple.
that is our economy. That's where money's made, is debt.
Yeah. But think about this as like a household. How much debt on a household can you take on and continue to survive at the level that you're comfortable with? It comes to a point where you have to say, okay, well, maybe that extra cell phone isn't worth it. And I can save myself $100 or whatever it costs anybody. You have to start thinking that way. But, you get politicians who have no whipsaw back to them when they make these outrageous decisions that affect the long term of everybody. That's the bigger problem. Nobody blames the people that say, hey, it's okay to issue more debt. Well, is a bank going to continue to lend you money on a household level? If you got a large mortgage on your house that maybe is under 90% of the value of the house right now, and you got an equity line on top of that, which is another 10%. So basically you're flat there. How much
And
more is a bank going to give you?
credit card debt, student loan debt, maybe a car payment.
Car loan,
Yeah.
car lease, whatever. You go into a car dealer after having all that debt, they run your credit report. They're going to say, man, you're overbought.
Well, Bob's been telling us for months now that the only one that banks are loaning to are people that don't need the money.
Yeah, it's true. And even then, they're going to run you through the coals. What was it? A year ago, we got a home equity line because we want to do some construction.